Wow, what a start into the new year. Market sentiment clearly turned positive. Equity markets are up and overall everything looks much better now. So the big question now is, can we sound the all clear signal? That's the big question that is at the top of everyone's mind, I guess. At least it was at the top of our mind when we discussed the outlook and the current situation in our last investment committee. And the short answer to that question is no, unfortunately not. We cannot see the all clear sound yet, even though things have improved. Now, the reasons for this, I will elaborate in the next couple of minutes. My name is Felix Prill. I'm the Chief Investment Officer of VP Bank. You might have some different questions for sure. So if that's the case, please, as usual, use the chat function. You can type in your questions, send them to us, and I will see them then later on the tablet here and will answer them after my introductory remarks. Now, when we look at 2023 and the outlook, I think it's still paramount to quickly take a step back and quickly reassess what happened actually in 2022. And I showed that slide already at our last live stream event in November. Now the difference is we have now the final data for the full year of 2022, but it did not change the overall message here. 2022 has been the worst year for the Swiss bond market in almost 100 years. We have data since 1926, and on that chart here, you see them ranked basically from the worst performing year, which has been 2022, indicated by the dark blue bar, until up to the best performing year, so each bar representing 1 year. And it's very strong message here. It has been not only the worst year, it has been by far the worst year. The second worst year was only a minus of around -5%. Now in 2022, it was more than twice of that. It was more than 10% minus. And now we have a long time series on Swiss bonds. Therefore, we are showing that here, but it's basically representative for basically all the currencies out there. So no matter what, if you look at the dollar, the euro, sterling, whatever, basically, it has been really a tough year for 2022. And with that, and as we discussed many times in the last year, has been a tough year for financial markets overall. Now, you could argue, well, after such a bad year, it's natural that things are going to be better in the year after that. And that's typically the case, but of course we can never be 100% sure that an extraordinary situation becomes not even more extraordinary. There's no guarantee for that. Having said that, there are indeed some good reasons why market sentiment has turned positive, and I have brought with me two charts representing that basically. On the one hand side, you see our supply chain indicator, which now it's on the left-hand side chart, the light blue line, basically going up back to 100. Now, 100 representing a normal situation, or the situation as it was before COVID started. Now, it has been a long way, but it has been now in the recent months pretty quick, and of course here and there we see still some issues in supply chains. If you look at specific goods or specific sectors, but overall it's no longer a big issue, and it's definitely no longer an issue for financial markets. So that is one tick. We can see all clear to some extent. That's clearly a positive news, because with supply chains now functioning kind of normal again, this is also very important for the other chart on the right-hand side. You see producer price inflation for some selected countries. You could choose Spain, UK, Germany, United States, pick one. The message and the pattern is similar. We have seen a strong increase, a surge basically last year. Producer prices increasing by like 50% year over year. That's huge, and it was not only driven, of course, by the supply chain issues, but especially also by the soaring energy prices. Now, This has changed. Of course, year over year, these lines indicate still producer prices being up, but the rates are only now at around, let's say, 10, 20%, no longer at 40%. And the direction is clearly positive in a sense that it's moderating and going down further. And that is very important because producer prices are at the beginning of the kind of the chain for overall inflation, because if companies have to increase or face increasing production costs, they will pass them through over time, of course, to the consumers. And we've seen that last year, and inflation has been the other big topic in general last year, with consumer price inflation seeing like record highs, at least over the last 40 years or so. In the US, almost reaching 10%. In Europe, we were even higher than 10%. Now, with these two positive developments here and energy prices also coming down, we see finally also quite reduction or decline in consumer prices, at least in the US. This is shown here on that chart. It's a dark blue line. US consumer price inflation was at around almost 10% last year. It has come down now to 6.5% as of December. So, and clearly also here the trend is very positive, indicating that consumer price inflation is continuing to decline going forward. And we see even more evidence for that if we look at the light blue line here on that chart, which is the result of a survey that has been, is being conducted each and every month with small, medium-sized companies, where companies are being asked what are the plans for price increases for the next 12 months. Now, this light blue line has come down as well, and indicating actually even a further decline of the dark blue line, because in the past there has been a very close relationship between these two lines, because inflation is not some theoretical thing. It's made up basically by companies, and if companies say they no longer gonna increase prices as fast as they used to, this will then, of course, over time has also an impact on the officially recorded prices. Very good news. Indeed, for not only for financial markets, but especially for central banks, because last year there were, you could argue, well, this could spin out of control. Inflation could spin out of control, and central banks got really worried. They were in the beginning a bit reluctant to start increasing rates, but when they did it really fast and strongly so. So especially the Fed, it was like 75 basis points, and having kind of really hit the brakes in terms of trying to make sure that inflation is not spinning out of control. And because of that chart and what we see, basically, this is a very good message for central banks, because it seems that we've definitely passed the peak of inflation. It's going down. Of course, we are not yet at the 2% or whatever the target of the central banks are for inflation, but the trend is clearly positive, which allows them, that is very positive for the narrative of financial markets, allows them to get closer to the terminal rate, to no longer having to increase rates as much as they did last year. For the Fed, we expect only 2 more rate hikes. The markets currently even expect only 1 additional rate hike. There's some uncertainty there for sure. We think the Fed really wants to make sure that things are under control, and we are really approaching the long-term target of 2%, and we are not there yet, even though the trend is positive. So therefore, we think there is a good chance that we see 2 more rate hikes. For the ECB, we see even a bit more. The ECB started later, and inflation is still a bit higher. But also here is kind of the end of the rate hike cycle is in sight. So that is clearly, that I think, the big topic for 2023. 2022 was like central banks fighting inflation, increasing rates. Now, in 2023, they still want to make sure inflation is under control, but they're approaching the terminal rate. So this is the big topic for this year. And the big question now is, when do they really stop, and might they even cut rates? And this very much depends on the economic development, because central banks not only look, of course, at inflation, but also on what the economy is doing. And these two factors are linked. The better the labor market, the economy is doing, typically the higher inflation is, and vice versa, right? And now with inflation coming down, central banks approaching maybe the terminal rate, the big question is, how's the economy doing? And the short answer is, or like twofold. The answer is, well, it's better kind of than anticipated. It's still doing good, but at the same time, we have to really state that it's definitely not all good here. You see that on this chart. This is basically I think, currently the most important chart because it tells us so much about the economic outlook. It's again for the United States, but what is very positive here, what is we know the data for many decades now, since 1960, and this chart shows the willingness of consumers in the US to purchase durable goods, like new furniture, a new car, something like that. So not everyday consumption goods, but rather like the expensive, the durable stuff. And the lower that line is, the more consumers tell us now is not a good time to do that. They are not willing to do that because maybe they have not enough purchasing power, they're uncertain about the economic outlook, whatever, right? We don't know exactly for sure, but it definitely tells us now, many consumers tell us it's not a good time. And if you compare that over the past, it's never been so low. And we have the data since 1960. And what you also see are these kind of grayish bars, right? These are indicating recessions. Whenever kind of that light blue line turned sour, turned south, deteriorated and was low, we always had a recession. And it would be, in our view, a big surprise if we don't see a recession at all this year. Of course, we can argue how deep will the recession be, but for us, it's very clear. It's most likely that we see a recession, and that's not reflected in the hard data yet. And this is another topic for this year. So therefore, this is one of the main reasons why I said in the beginning we can't sound the all-clear signal yet, because recession is still on the table, and we still have to face that recession. And okay, now this is a picture, like this is a strong statement for the United States, but I said this chart is super important for the economic outlook in general. And the reason for that is it's also super important for China, because the US consumer is still the biggest consumer in the world, and it's very big consumer for China. Now, China reopening is super interesting for the global economy, because there's also now probably the pattern of pent-up demand unleashing in China. But the Chinese economy is also very much dependent on what the US consumer is doing. And if the US consumer is not spending as much as he or she did in the past, this will also be negative for the Chinese economy. So therefore, we're also a bit skeptical on the optimism surrounding the Chinese economy, and we would be rather kind of a bit reluctant to now really jump onto that reopening and everything is good signal, right, or the train. So therefore, that's the main reason for us to say, well, with regard to equities or risky assets in general, we should be still a bit more cautious. Now, because that rebound in equity markets since the beginning of the year, in our view, given that outlook for the economy, has been too strong and too fast. And we think a lot of that optimism, a lot of that improvement of underlying data is more than reflected in the current data, in the prices. And we see elevated risk that we see, we're going to see also some setbacks again. And therefore, we remain underweight equities. But being cautious doesn't mean that there are not any other, like options or chances to do something in the portfolio. And we think very interesting, much more interesting than definitely last year is our bonds. We see the higher yields throughout last year. We came from a strong underweight and closed it throughout the year. And now in general terms of government bonds, we think that is interesting. You get decent yields. And on top of that, now with that decent yield, the interest rate sensitivity is still there, of course, but it's no longer as asymmetrical as it was a year ago. A year ago, you had a lot of interest rate risks in the portfolio. Like if interest rates go up, it hurts, right? And the room for further decreases was limited. Now, it's kind of symmetrical. It could go up, of course, but it could also go down if that recession topic gets more and more again into the markets. And with that, then also offering protection for the portfolios. Therefore, we think it makes a lot of sense to have, again, more bonds in the portfolio, but also not only the kind of safe kind of thing, like the government bonds, but also more the risky, a bit more risky stuff. We are not talking yet about high yield, but something else, namely emerging market bonds. A couple of reasons for that. We decided in our last investment committee to go overweight on emerging market bonds. The reasons for that call are, first, you see a higher yield now of around 6.5%, 7%, depending on the day when you're looking at and the index you're looking at, but that's decent. Like that offers a lot of kind of nominal yield as of today. Second reason, the dollar has weakened, and we even see further weakness ahead, and this is typically positive for emerging market bonds. Thirdly, if you look at the composition of the broader indices, then actually they improved over the years. Now, roughly speaking, you have 60% investment grade in an emerging market bond index and only 40% high yield. So it is not as risky as you might have many thought of. And finally, the fourth reason is also if you look at the different countries, the compositions of the biggest countries with the biggest debt in there, it's no longer Russia and so on after last year, of course. Now it's China and Qatar and so on. Countries, of course, where you also face risk in terms of the credit rating and so on. But, it's less risky in our view than in the past. And so therefore we think now it's a good time to add some more emerging market bonds to a portfolio, bringing the overall bond quota to an overweight. And as I mentioned, we remain underweight in equities and overweight on top of it in alternatives with insurance-linked securities to make sure that the portfolio is still very much diversified, because we face still some uncertainties going forward. With that, thank you very much already for listening. Now I quickly take that tablet here and see if there have been some questions. First, there's one in there. You recommend emerging market bonds. Aren't they particularly vulnerable when it comes to a recession? Well, yes and no. Yes, of course, if you see a big global recession, a deep global recession, which is not our call. We say we face a recession, but we don't expect it to like a deep recession. But in that scenario, of course, then emerging market bonds are typically also hit by that. But there are, and that's the second part of the answer, positive aspects. I mentioned already some of them in the sense that the underlying quality looks much better than, let's say, 10 years ago. But on top of that, what we've seen last year, that many central banks in emerging markets started earlier to rate hikes. They did more. And now inflation is actually not such a big issue than compared to the United States, or has not been such a big issue like in the United States or in Europe. Now, central banks in emerging markets are actually in a better position to cut rates earlier, and with that to support the economy, and with that also supporting then the bonds. So I think that is a bit of a cushion if things turn sour. Second, another question, technology stocks suffered quite a bit last year. Is it worth getting back in now? Now, to be consistent and saying that we are a bit cautious with regard to equities, the answer has to be no. In general terms, there are good reasons for that, at least I think. First is tech stocks are like very kind of sensitive in terms of growth, and as well very sensitive in terms of interest rates. Now, in terms of growth, we expect a recession, right? So that is not the best environment for tech stocks. They are more sensitive to a deterioration of market sentiment if you're talking about recession than a kind of a defensive stock. And on the interest rate side, it's similar. The higher interest rates we're seeing today, which is positive for bond investors now, is actually not that good for growth and tech stocks in particular, because you have to discount your future earnings by a higher interest rate, by a higher discount factor, which means your valuation is going to be lower. And from a fundamental point of view, that's not super interesting right now. And we have, and the final part to that answer is, we've seen already quite a rebound also in tech stocks at the beginning of the year with the overall improvement of market sentiment. I think they're also at risk. If there's a setback or deterioration in market sentiment going forward, then the tech stocks are going to be hit as well. Having said that, of course, you can always look at each and every stock. My colleagues are doing that. We have different buy and sell and hold recommendations. If you're interested in more details on a particular stock, please feel free and please reach out to us. We are happy to discuss your personal situation then in more detail. Just checking, updating. No further questions. With that, then again, thank you very much for joining in, for listening. In case you have any question, please feel free to reach out. If I don't hear anything from you, I wish you a very good day and a good time, and of course, stay safe. Bye.